Little bit about the highlights of the quarter gone by, because you have achieved a break-even cash flow from operations. Is that a correct assumption?
I think the highlights has been is that finally, our efforts to create a completed inventory and sell completed inventory is now getting recognized. It's interesting that both from a regulatory framework and also from an accounting standard framework, our business model is fully aligned to it. So during this quarter, we of course recognized revenues based on a new accounting standard, which was where we can only recognize after we receive an occupancy certificate or a partial occupancy certificate on a particular project, and we deliver that property to him in the form of a possession letter. So basically, as the control passes from us as a developer to the customer, only at that particular point of time we are recognizing revenues. So purely from that perspective, I think the full alignment has happened. Something unfortunately the markets were not able to understand over the last, I would say, 8 to 12 quarters. But as we go forward, as we deliver completed inventory on sales done earlier, we will see better recognition of revenues in the future quarters.
Okay. Also wanted to understand then as to what is the impact of the new accounting norms and, after changing to the project completion method of calculating revenues, are you seeing a big impact kick in?
So actually, it's many years of revenues and profits that had to be adjusted for. So if you look at our analyst presentation, we have guided that the gross margins in many of our projects had to be reversed from our reserves, almost 8,000 odd crores, and on an after-tax basis, about 5,300 odd crores had to be reversed. These are apartments or units or plots which had been sold, but the possession had yet to be given. But as we go forward, because all the occupancy certificates have been received, other than 2 of our projects, all these, as they get delivered, the revenue will be re-recognized. So I mean, when you're talking about maths, you're talking about that my gross margin of almost 8,000 crores or net of 5,300 odd crores over the next 2 odd years will get recognized back in my books. In addition to this, of course, you add on to the new sales. So the 600 crores that we did in Q1 will get recognized in a time frame of anything between 6 to 12 odd months. So that recognition cycle is also compressed because these are all completed products from our stable. So I think, as we go forward, we are going to see much better reportage. But again, I would like to caution investors that this is a lumpy business. Even issuance of possession letters is not something which is as simple as I'm putting it across, and hence there will be some lumpiness in our quarters forward. But the general trend line is all upwards.
Right. How has the rental operations performed in Q1 of FY19? Do you expect it to continue to perform well for the rest of FY19?
Yes, that business continues to do well. It continues to do as per our agreed budgets with our investor, which is GIC Singapore. We don't see much turbulence in that business. It's easy to predict. There is still shortage of grade A offices, which are the preferred destinations by most of the IT companies. In our own portfolio, we see a lot of evolution where we see the low rental business going out and a higher rental business coming in. So it's a business which is of course evolving, and I think what we have guided the markets is that we should see a cumulative growth in that business over the next decade of something in mid-teens, around 14-15 odd % is something which we believe we can achieve in that segment of business.
Will development business be able to generate an operating cash surplus over the next 3 years? When will pressure on DLF's development business cash flow end?
So to answer in a very cryptic way, yes, it will generate substantial amounts of operating free cash in this segment of the business. We are on our way to do that. I think, as I told you earlier, the trend line is pointing towards that, and next 2 to 3 years, if you remain invested in the company, you should see substantial value creation.
Right. So will your rental assets sustain rental growth despite oversupply in the Delhi NCR region?
See, this is a very generic statement that we keep hearing. Even today in Cyber City, which is one of our larger campuses in our whole portfolio, we are renting it out at more than 100 rupees a square foot. The oversupply that you talk about, which are christened as offices, are not grade A, and they are not based out of a destination which has both connectivity and also has a lot of social infrastructure around. So you need to look what is the asset, where is it located, what are the linkages in the infrastructure, what is the ambience that an employee has in those spaces, and everybody is wearing down to campuses which are large, and that's why, frankly speaking, we have seen good momentum in our rents. So we continue to have good momentum in that space. Our average rentals in Cyber City are still much lower, but as we do releasing of the old rentals, they are all above 100 rupees a square foot. So we don't foresee any turbulence in this particular space. This also extends to some of our other destinations like Chennai and Hyderabad.